For nearly 2 decades, Bernie Madoff's investment advisory business reported steady, positive returns, year after year, no matter what the market did. In 2000, when the dot-com bubble burst and the Nasdaq crashed 39%, Madoff's clients saw positive returns. In 2001, when markets collapsed after 9/11, Madoff's clients saw positive returns. In 2002, when the S&P 500 fell 22%, Madoff's clients saw positive returns. Month after month, year after year, Madoff delivered consistent gains with remarkably low volatility. This performance was so impressive that Nobel Prize winners invested with him. Hedge funds marketed exclusive access to his strategy. Charities entrusted their endowments to him. Wealthy families parked generational wealth in his accounts. Financial advisors considered it a privilege to get their clients into Madoff's fund. And every single number was fabricated. There were no investments, no trades, no portfolio, just fake account statements printed on expensive paper and mailed to clients who believed they were getting richer. The money wasn't invested, it was spent. New deposits paid old withdrawals. The whole operation was a Ponzi scheme on a scale never seen before. At its peak, Madoff's investment advisory business claimed $65 billion in client assets. $65 billion. That number appeared on account statements, on client reports, and in the minds of thousands of investors who thought their money was safely growing. But those assets didn't exist. They never had. The actual cash that flowed through the scheme was far smaller, and most of it was already gone. This is the Money Timeline. Today, we're going to examine Bernie Madoff's Ponzi scheme. We'll look at who Madoff was and how he built the credibility to pull this off, how the scheme actually operated and why no one caught it, how he convinced some of the world's most sophisticated investors to hand over billions, why regulatory and audit checks failed repeatedly, how the 2008 financial crisis forced the collapse, and why the scheme was always doomed once the inflows stopped. This is not about greed or morality. This is about the mechanics of financial fraud at systemic scale. Bernie Madoff was not a con artist who appeared out of nowhere. He was a Wall Street institution, a former chairman of Nasdaq, the founder of Bernard L. Madoff Investment Securities, a legitimate and well-respected market-making firm, a man who had been in the financial industry for decades and was deeply connected to regulators, politicians, and industry leaders. Madoff started his career in the 1960s as a small stockbroker and market maker. His firm executed and matched orders for clients. This was a real, legitimate business. Madoff's trading operation handled billions of dollars in transactions for other firms. It was profitable, well-run, and respected. The firm employed hundreds of people. It had a trading floor, technology infrastructure, and all the trappings of a successful financial services company. This legitimate business was critical to the fraud. It provided cover. When clients, regulators, or auditors looked at Bernard L. Madoff Investment Securities, they saw a functioning firm with decades of history, a real trading desk, and daily market activity. They didn't see a Ponzi scheme because the Ponzi scheme was hidden inside the advisory arm, separated from the legitimate market-making business. Madoff's public persona reinforced the illusion. He was sophisticated, well-dressed, and calm. He served on industry committees. He testified before Congress. He donated at charities and political campaigns. He was not flashy or ostentatious. He lived well, but not extravagantly by Wall Street standards. Everything about him signaled stability, respectability, and competence. This credibility was the foundation of the fraud. Investors did not scrutinize Madoff the way they would scrutinize an unknown fund manager. They trusted him because he was Bernie Madoff, former Nasdaq chairman, industry veteran, trusted by thousands. The reputation was an asset more valuable than any marketing campaign. The mechanics of Madoff's Ponzi scheme were remarkably simple once you strip away the complexity and sophistication. Madoff's advisory business claimed to use a strategy called split strike conversion. This involved buying a basket of stocks, selling call options above the purchase price, and buying put options below the purchase price to limit downside risk. On paper, this was a plausible if complex investment strategy. It sounded sophisticated enough to justify consistent returns without being so exotic that it raised suspicion. But the strategy was fiction. Madoff was not executing these trades. He was not buying stocks or options. The entire portfolio was fake. Client account statements showed holdings, trades, gains, and losses, but none of it corresponded to real securities. The statements were fabricated using basic software and printed on letterhead that looked official. The operation worked like this. A client would deposit money into their account. That money did not go into investments. It went into a bank account controlled by Madoff. When another client requested a withdrawal, Madoff paid them using funds from new deposits. If a client wanted to see their account statement, Madoff's office would print a fake document showing fictitious trades and balances. The numbers on the statement had no connection to actual securities transactions. Madoff kept internal records, but these were minimal and designed to avoid scrutiny. The advisory operation used a tiny, obscure accounting firm, not one of the major auditors that would be expected for a firm managing billions. Internal bookkeeping was intentionally opaque. There was no independent custodian holding securities, no third-party verification of trades, no reconciliation with external market data. This was not a complex financial engineering scheme. It was a lie, supported by fake paperwork and sustained by the fact that most clients never questioned the statements they received. They saw steady returns, received their withdrawals when requested, and assumed everything was legitimate. The scheme depended on a simple arithmetic. As long as new deposits exceeded withdrawals, the system functioned. Madoff needed a constant inflow of cash to pay existing clients. Growth was not optional. If deposits slowed or stopped, the Ponzi would collapse because there would be no money to pay redemptions. Madoff did not advertise. He did not cold call potential investors. He did not need to. His reputation and an aura of exclusivity did the marketing for him. Madoff cultivated the image of a selective, elite investment manager. He did not accept just anyone as a client. There were minimums, there were waiting lists. Access was granted through referrals from trusted advisors or existing clients. This exclusivity made people want in. If Madoff was selective, if he turned people away, then getting access must mean you were part of an exclusive club. This psychology is powerful. When something is scarce or restricted, people assume it is valuable. Madoff's selectivity implied that his strategy was special, that he had insights others didn't, and that only the fortunate few could benefit. Investors felt privileged to be accepted, which made them less likely to ask hard questions. Madoff also relied on feeder funds. These were hedge funds and wealth management firms that pooled client money and invested it with Madoff. The feeder funds marketed access to Madoff's strategy as their value proposition. They charged fees for the privilege of investing in Madoff's fund. Some of these feeder funds were enormous, managing billions of dollars. They conducted their own due diligence, or claimed to, and their endorsement added another layer of credibility. The problem was that the due diligence was often superficial. Feeder fund managers were incentivized to believe Madoff because their business model depended on it. If Madoff was legitimate, they collected fees. If they questioned him too aggressively, they risked losing access. So they accepted his explanations, relied on his reputation, and did not dig deeply into the operational details. Word of mouth reinforced the cycle. Wealthy individuals, family offices, and institutional investors heard from trusted advisors that Madoff was delivering consistent returns. They saw other sophisticated investors allocating capital to him. Social proof is a powerful force. If Nobel Prize winning economists and multi-billion-dollar hedge funds trusted Madoff, why would a smaller investor question him? Madoff's returns also looked plausible. They were not outrageously high. He did not promise 50% annual gains. His reported performance was in the range of 10 to 12% annually, with very low volatility. This was attractive, but not so extreme that it screamed fraud. In fact, the steadiness was the selling point. In a world where markets fluctuate wildly, Madoff offered stability. Investors craved that, especially wealthy retirees, charities, and endowments that needed predictable income. The consistency was the red flag, but few recognized it. Markets do not produce steady, positive returns every single month for decades. Volatility is inherent to investing. Madoff's performance was statistically improbable. But because it was not wildly excessive, and because his reputation was so strong, investors rationalized it. They assumed he had proprietary insights, superior risk management, or access to information others didn't. At its peak, Madoff's investment advisory business claimed $65 billion in client assets. This was the total shown on client account statements. The actual cash that flowed through the operation was significantly less, but the nominal balances were staggering. The client list was a who's who of wealth and institutions. Individuals, family offices, hedge funds, pension funds, university endowments, and charitable foundations all had money with Madoff. The fraud touched every sector. Jewish charities were particularly hard hit because Madoff was a prominent member of that community and cultivated trust through religious and cultural connections. The scale raises an obvious question. How did a fraud this large survive for decades? The answer involves several reinforcing factors. First, the legitimate trading business provided cover. Madoff's firm had real operations, real employees, and real regulatory oversight for the market-making side. This created the appearance of a fully functional financial institution. Regulators visited, audits were conducted, but the advisory business, where the fraud lived, was kept separate. Auditors focused on the legitimate side. The advisory arm used a tiny accounting firm that lacked the resources or expertise to conduct meaningful audits. Second, the feeder fund network concentrated capital and reduced scrutiny. Instead of thousands of individual investors each conducting due diligence, Madoff dealt with a smaller number of feeder funds that funneled billions his way. These intermediaries were supposed to perform oversight, but many did not. They trusted Madoff's reputation and prioritized maintaining access over asking uncomfortable questions. Third, the fabricated returns were conservative enough to avoid suspicion. If Madoff had reported 50% annual gains, skepticism would have been immediate. But 10 to 12% with low volatility looked plausible, especially during periods of market growth when legitimate funds were also performing well. Fourth, the economics of the scheme were self-reinforcing. As long as new money kept coming in, Madoff could pay existing clients and maintain the illusion. The steady performance attracted more capital, which funded more withdrawals, which reinforced confidence. It was a virtuous cycle as long as inflows exceeded outflows. Fifth, investor psychology worked in Madoff's favor. People who saw steady returns on their statements felt wealthy. They did not want to question it. Withdrawing money or demanding transparency risked losing access to a fund that seemed to work. Cognitive dissonance kept many investors from asking hard questions, even when warning signs appeared. Sixth, regulators failed repeatedly. The SEC received tips and complaints about Madoff over many years. Independent analysts flagged the statistical impossibility of his returns. Whistleblowers provided detailed evidence of fraud. But regulators did not act. Some investigations were cursory, others were closed without resolution. The combination of reputational deference and weak processes allowed the fraud to continue. The scheme worked for so long because it existed at the intersection of credibility, complexity, and systemic failure. Madoff had the reputation to deflect scrutiny. The structure was opaque enough to hide the fraud. And the institutions that were supposed to catch it, auditors, regulators, intermediaries, did not do their jobs. The failure of oversight was not an accident. It was structural. Madoff's advisory operation used a tiny accounting firm based in a suburban strip mall. This firm, Freeling and Horowitz, had 3 employees. One was semi-retired, another was a secretary, and the third was the accountant who signed off on Madoff's audits. This firm was auditing a business that claimed to manage tens of billions of dollars. The absurdity is obvious in hindsight, but at the time, few questioned it. The accounting firm did not conduct real audits. It rubber-stamped whatever Madoff provided. There was no independent verification of holdings, no reconciliation with external custodians, no testing of trade records against market data. The auditor simply accepted the fabricated documents and issued clean opinions. Regulators visited Madoff's operation multiple times. The SEC conducted examinations. But these inspections focused primarily on the legitimate market-making business, not the advisory arm. When regulators did ask questions about the advisory side, Madoff provided explanations that sounded plausible, and regulators accepted them without digging deeper. In 2000, an investment analyst named Remarkably conducted a detailed investigation of Madoff's returns and concluded they were mathematically impossible. He submitted a report to the SEC outlining the evidence of fraud. The report was detailed, technical, and compelling. The SEC did not act on it. Markopoulos submitted additional reports in subsequent years, each time providing more evidence. Each time, the SEC failed to pursue the matter seriously. Why did this happen? Several reasons. First, Madoff's reputation created a credibility shield. Regulators found it hard to believe that a former Nasdaq chairman and respected industry figure was running a Ponzi scheme. Cognitive bias worked in his favor. Second, the complexity of financial markets made it easy for Madoff to deflect questions with technical jargon and sophisticated-sounding explanations. Regulators who lacked deep expertise were reluctant to challenge him. Third, the SEC was under-resourced and focused on other priorities. Investigating Madoff thoroughly would have required significant time and expertise, and the agency did not allocate those resources. Feeder funds also failed to conduct meaningful due diligence. Many of these funds hired consultants and conducted site visits, but their reviews were superficial. They did not demand independent verification of holdings. They did not insist on audits by reputable firms. They accepted Madoff's explanations and focused on the performance numbers rather than the operational details. Some feeder fund managers may have been willfully blind. Their business models depended on Madoff. If they pushed too hard and lost access, they would lose fees and clients. So they asked soft questions and accepted soft answers. This created a system where everyone had an incentive to believe the fraud. The combination of weak auditing, failed regulatory oversight, and superficial due diligence by intermediaries allowed the scheme to grow to catastrophic proportions. By the time it collapsed, the damage was systemic. The global financial crisis of 2008 was the event that finally exposed the fraud, not because regulators discovered it, not because an audit caught the fabrication, but because the crisis created a liquidity shock that broke the Ponzi arithmetic. In late 2008, financial markets were in freefall. Lehman Brothers collapsed, credit markets froze, investors everywhere faced losses and scrambled for cash. Madoff's clients were no exception. Many of them, especially hedge funds and institutional investors, requested withdrawals. They needed liquidity to meet their own obligations or to cover losses in other parts of their portfolios. For a legitimate investment manager, meeting redemptions is routine. You sell assets and return cash to clients. But Madoff had no assets to sell. The portfolios on client statements did not exist. There were no stocks to liquidate, no bonds to sell. The only cash available was from new deposits, and in the midst of the financial crisis, new deposits had dried up. Redemption requests surged. Clients wanted billions of dollars. Madoff could not fulfill them. He stalled. He tried to reassure clients. He delayed payments. But the requests kept coming and the cash was not there. In early December 2008, Madoff confessed to his sons that the advisory business was all just one big lie. His sons, who worked in the legitimate trading side of the firm, were reportedly unaware of the fraud. They reported their father to federal authorities. On December 11, 2008, Madoff was arrested. The collapse was rapid. Once the confession was made, the entire operation unraveled within days. Account statements that showed $65 billion in assets were revealed as fiction. Thousands of investors, from billionaires to retirees, learned that their life savings had vanished. Charities discovered their endowments were gone. Pension funds faced massive losses. The timing was particularly brutal. The financial crisis had already devastated portfolios and retirement accounts. Investors who thought Madoff's fund was a safe haven discovered they had been wiped out. The double blow, market losses plus Madoff fraud, was catastrophic for many. The collapse was not caused by bad investments or market downturns. It was caused by the fundamental arithmetic of a Ponzi scheme. The system depended on continuous inflows to fund withdrawals. Once the 2008 crisis stopped those inflows, the scheme could not function. There were no real assets to liquidate. The only choice was confession and collapse. A Ponzi scheme is mathematically doomed. It can only survive as long as new money keeps coming in faster than old money is going out. The moment that reverses, the scheme collapses. Madoff's fraud lasted for decades because he was able to maintain that flow. But no fraud can sustain indefinite growth. Eventually, something breaks. For Madoff, that break was the 2008 financial crisis. But even without the crisis, the scheme would have collapsed eventually. As the nominal account balances grew, the cash needed to fund redemptions grew proportionally. Madoff would have needed exponentially increasing inflows to keep pace. That is unsustainable. The economic impact of the collapse was enormous. The nominal losses totaled $65 billion in account balances that vanished. The actual net losses, after recoveries, have been estimated at around $17 to $20 billion. This represents the real cash that victims lost, accounting for withdrawals that some clients had successfully made before the collapse. A court-appointed bankruptcy trustee, Irving Picard, launched an aggressive recovery effort. He sued feeder funds, recipients of large withdrawals, and anyone connected to the fraud who had profited. Over the following years, billions of dollars were clawed back and returned to victims. Some investors recovered a significant portion of their losses. Others got little or nothing. The reputational damage extended far beyond Madoff himself. Feeder funds collapsed. Wealth management firms that had marketed access to Madoff faced lawsuits and lost clients. Auditors and consultants who had vouched for Madoff's legitimacy were discredited. The entire industry of financial intermediaries came under scrutiny. Charities were devastated. Some lost their entire endowments and were forced to close. Others slashed operations and laid off staff. Jewish charities were disproportionately affected because Madoff had cultivated trust within that community. The emotional and financial toll on these organizations was immense. Regulatory reforms followed. The SEC implemented changes to oversight practices, increased scrutiny of auditing firms, and created new requirements for verifying the existence of client assets. Custody rules were tightened to ensure that independent third parties held securities, not the investment managers themselves. These reforms were designed to prevent a repeat of the Madoff disaster, though critics argued they did not go far enough. Madoff himself was sentenced to 150 years in prison. He died in 2021 while incarcerated. His sons, wife, and associates faced legal and financial consequences. The family name became synonymous with fraud. The Madoff scandal was a lesson in the limits of trust without verification. Investors, auditors, and regulators all failed to verify the existence of assets. They trusted reputation, accepted plausible-sounding explanations, and did not insist on independent proof. That failure allowed a fraud of systemic proportions to persist for decades and inflicted enormous damage when it finally collapsed. Thanks for watching The Money Timeline.